So today we're going to talk about what happens when there's a short appraisal. Hi, I'm Dawn Connors, Mortgage One. So if there's a short appraisal, let's say your contract is for $400,000 and the appraisal comes back at $375,000. The sellers have the opportunity to come down to meet the sale price of $375,000, keeping all terms and contract commitments the same. If they won't do that, the buyer has some options as well. Number one, you could come and bring the difference to closing. So you could have your regular down payments that you were planning to put down, and you can bring an extra $25,000. That is definitely an option should you wish to do it. You'll want to write a letter for your lender that says why you believe that the house is worth more than what you paid and why you're willing to do it. Maybe it's a great school district for your kids. Maybe it's close to your family. Maybe you believe the area is going to be up and coming and so you're willing to do it, whatever the reason is. The other option that you have, this number two option, is that you could lower your down payment and pick up some PMI insurance. So let's say that you were putting 20% down, which on $400,000 is $80,000, and your loan amount was going to be $320,000. You could technically keep your loan amount at $320,000 and have incur some PMI insurance, because now your down payment will be based upon a value of $375. So $320 divided by $375, and that will be your loan to value, and you'd have a little bit of mortgage insurance. Quite surprisingly enough, PMI insurance, number one, is based on credit score. So if you have an excellent credit score, you're going to have low PMI insurance. Number two, it's also based on how much down payment there is. So it moves in 5% increments. So the more down payment you have, the lower the PMI insurance. You might be pleasantly surprised to learn that PMI insurance might only cost you $16 to $32, for example, just depending on those parameters. And the next option that you have is you can dispute the appraisal. You can have your real estate agent or yourself provide comparables, listings of homes that have sold comparable to yours in the marketing area that justify a higher value. And then you submit that into the lender with your dispute written out, and they will then dispute the appraisal. It's a process that takes about 1 week, and they'll come back with reasons why they didn't use the comparables, or they will come back with increasing the value using a comparable. A lot of times what makes a value increase is maybe they had the wrong square feet on a house and you do that correction, or maybe they say that it's a 2-car garage and it's really a 4-car garage, things like that. So if you see that there's discrepancies or wrong material, like there's another bathroom above grade that they didn't account for, so things like that really make a difference. And the last thing that you can do, although it's painful, is you can walk away from the house. You can cancel the contract, because as a buyer, you have the ability to do that. As long as you didn't have in your contract spelled out that there's no appraisal contingency, you can absolutely cancel the contract, wash your hands of it, go on and look for another house. That does mean that you've lost your appraisal money if you paid for it, and your inspection money. It does not mean, however, that you would lose your earnest money deposit. You would get that money back. The money that you gave to the contract to hold the house would get refunded to you, and you'd go on your way to look for another home. So these are the options when you have a short appraisal. It's really important to know what those options are in advance, during the process, in the middle of it, so that you can think clearly with a keen mind, because a lot of emotions are flying as a buyer and as a seller when a house doesn't appraise. Thanks for watching. This is Dawn Connors at Mortgage One. Please like, share, and subscribe to this video. Thank you.